So here's the agenda for today. So today I will first talk about the income statement analytics. So basically, what exactly we can get out from income statement. How do you do analytics on the income statement? How do you predict the stock price in particular? And then uh, uh, and then I will also talk about several technical stuff. Like when I say predict future return, how to calculate abnormal return. When I say abnormal return means, give you guys an example. Let's say I told you guys I earned like I have like 40% stock return from past year. How can we tell the 40% past return is actually from the risk or it's from my skill? Like maybe I'm very skilled person, I get 40% stock return. Maybe I just lucky, I just get a 40%, just randomly get 40%. So how exactly we get that risk adjusted returns, and how, and also we talk about farmer bets, some technology and stuff. And and also I will introduce the project one, it's due next week. So so basically the plan today is uh, give you guys what exactly is the income statement analytics look like. That's the first thing. The second thing is I will give you guys the concrete big picture of what is income statement data look like, and then I give you guys example uh, how exactly we can use income statement to predict the future stock price. And then once after that, we have a group four. Group four will come out to present the example in a detailed way. So I will talk about the income statement analytics first in different ways. And we have a group four, very nice group four. Will discuss the very detailed example of how exactly we can use income statement information, do analytics, and use that to predict stock price. So this is basically a agenda for today. So let's look at the what screen we have right now. Can you guys see the screen? And also, can you guys hear me? My voice is good. My voice is good. Okay. So okay. So let's see. This is the firm. This is the firm. Firm provides a lot of information, and this is the users of the firm information. So basically, what I'm trying to say here is investors, they can use firm information, managers can use the firm information, creditors can use firm information, supplier customers, though all can use firm information. So for us, for we most of time we provide data analytics for investors. That's most of the time we do that. Um, provide that. We provide the we provide the data analytics for investors, and sometimes we do that for managers. So sometimes we do that for creditors. So just uh, remember who are the audience. When you provide the data analytics for the audience, different people have different purpose. Shareholders, they want stock price. Managers, they want to know the cash flow management decisions, leverage decisions. Creditors, they want to know whether the cash flow can be paid. So these are the something you have to keep in mind when you do the data analytics. You always remember who are the audience. Provide data analytics for a particular audience because their interests are different. This is one thing I want to emphasize. And then and then I give two slides, introduce different data we'll cover in the class. So these are the data we'll cover for the rest of semesters. We will cover the income statement analytics. So basically how to use the income statement data to predict stock price and help help manager make decisions. Balance sheet analytics. So basically, how can you get the balance sheet data to predict price and help managers and the analysts? Analysts, they provide the recommendations, earnings forecast. So how to use their data to understand the capital market. and also compensation data, bank loan data, patent data, voluntary data. So these are all important data that we need to learn as a finance and accounting major in order to provide data analytics for investors, managers, creditors, government. So I'm not going to spend too much time on these details of the data. I will post some video to you guys. In that video I, uh, I I explain all the data in details. So for example, for income statement balance sheet, we can use that to calculate the leverage, to calculate. So for example, the bank will be interested in the balance sheet because balance sheet can tell bank whether the company has the assets to pay back the money in the future. Investors may more interested in the income statement because the income statement will tell the investors the profitability of the firm, so investor can know whether they should invest in the firm. So, and compensation can tell you how exactly we can make CEO work harder, how to push them work harder. Bank loan data will tell you whether the firm is doing okay with bank, the contract is efficient or not. So each data has their own purpose. You can check some other tutorial video I posted so you can see how exactly we understand each data. So the basic point here is, as a finance accounting students, um, you need to first understand this data, nature of the data. That's number one thing. Number two thing is you need to use the data to help different people, to help investors, to help managers. That's the idea behind this class. I also have another the slides to talk about the textual data. Like I said, for right now, we don't focus on textual data for the session. But you guys can check. You guys can check. This is something you can learn as well. And for this class, the homework you have, the project you have is only doing annual report. That's the most important textual data. But there's a lot of other textual data available there. So, for example, you can calculate the political risk, climate risk. You can get the firm information from the firm's social media website. So the idea here is there's a lot of textual data about the firm available out there. For you guys, you can just do the 10K stuff. That's what we going to do, the 10 stuff. But if you guys interested, you can check the I just built a Bilibili website. You can see there's a link here. I was joking around. I only have very few fans on my Bilibili. So if you guys like it, if you guys want to step out of your comfort zone to learn something more, go to the video and you can watch some stuff about this textual data. And yeah, this is the link here. So the slides will be online, so you guys will have the link. So basically, that's the idea. That's the idea. That just before I start, I want to let you know you need to know your audience because different people have different purpose. Auditors want to know whether the firm is making faking the numbers or not. Managers want to know some investment decisions. So you need to know the audience. And then also for the data wise, we will focus on the numerical data. And the key point is you need to understand the structure of the data, nature of the data, and how to use the data to help investors, managers to make decision making. And the textual one is a extra for you. For me, I only if you guys can do the annual report, it will be good. For other data, you can just check my Bilibili one. This is very fresh. I just made it very recent. So let me go over the income statement. So this is the very simple example of income statement. I will give you more complicated income statement example. So income statement, you can see that we start with revenue, and then cost of goods sold is the cost of the company, and then research and R&D, that's expense, and the sales and marketing is expense as well. General and administrative expense, that's also expense. Goodwill impairment. So added together, it will be total operational expense. And you use the revenue to minus the operational expense, you get operating income. This is very fundamental stuff. I'm sure everyone, you guys know it. And then we have other income. So the company has other income. $500 some dollars, and the income before tax, and some income, and you get the final income statement. So there's two things I want to discuss on the income statement. First thing is, when people look at the income statement, normally people look at the bottom line number. So here, 16,978, look at the bottom line number. But the bottom line number is from different things. The bottom line number is actually, it's a combination of the operating income and the other income. Let's say this bottom line number. Let's say forget about tax. So let's say people look at the 22,267, the number. Let's say people focus on this number. So one message I want to deliver is, if you just look at the bottom line number, you may miss some information. For example, here we have other income, we have operating income. One message I want to point out, which is your project one, is what's the nature of operating income and what's the nature of other income. Let me explain to you what does operating income mean, what's other income mean. So for example, if I'm a manufacturing company, my operating income is the income from selling the product. That's operating income. So what is my other income? I maybe rent out my facility to other company. I get a rent income. That is my other income. Maybe I have some free cash flow. I use the cash flow to invest in stocks. I gain some gains from stock investment. That's my other income. So one thing I want you guys to think is, do you want like holding the income constant? Do you want high proportion operating income, or do you want to high proportional other income? So just rephrase the question. My point is, let's say the company is earning $22,260. That's constant. Do you want the number is all from the company's primary business operating income, or do you want the number is from the company's side business, like a rent out facility, like a stock investment? Which one do you prefer? Which one do you prefer? I'm sure you guys have the answer. I'm sure you guys have the answer. So what's the idea? So why do you want? So once you have the $22,260, why do you want the number? The most of number is from the operating income, primary business. Why you do not want the number is from the company's side business, like stock investment? Why is that? The one reason I want to tell you guys is because the persistence. The reason is because the income from the company's primary business will persist. So for example, if I have a contract with Apple, and this is my primary business, likely I will have the same contract in the future years. But if I invest in stocks, I can gain return from this year's stock investment. How likely I can gain return from next year's stock investment? I'm just a manufacturing company. I'm not a professional investor. How can I know the gain from this year's stock market will continue to the next year's stock market investment? So the reason we want the bottom line number from the primary business is because the primary business is the company's core business competitive advantage. So if the most of proportional income are from primary business, and then we will have the company will have more healthier return in the future, more healthy income in the future. So that's the idea. I would spend more time on that. But the idea here is, after you take this class, do not just focus on the bottom line number. Just do not focus on, oh, the company is making $22,267 income. That's not a question number you should fix on. You should see the proportion. How much is from the primary business? How much is from the other business? You want a high proportional income from primary business because this is repeatable. This is recurring. Because the primary business income can continue in the future. That's what you want. So this is just one example. This is just one example how exactly you should understand income statement. You should understand the income statement. That's just one example. Let me share my screen with you, and you can see what income statement data look like. Um, can you guys see my screen? Okay. So these are the data variables available for you guys to do analysis. So basically, all the data here are from the income statement and the balance sheet. So can you guys see the bottom here, the income statement, balance sheet, income statement, and cash flow? Can you guys see the no? Cannot see. Can you guys see this Excel file?
No, we are just seeing the folder, Professor.
Folder? Okay. Can you guys see now?
Yes.
Okay. Okay, excellent. So can you guys see the name of the each spread? There's a balance sheet annual, balance sheet quarterly, annual income statement, income statement quarterly, and cash flow. Can you guys see all the name of the spread? Okay, so this is basically the example of the data you can use for doing analytics for this class. So let's look at the income statement. So this is the annual one. Okay, this is annual income statement, and this is the quarterly income statement. They are very similar. They're very similar. Let's just focus on annual income statement. So so you can see that the structure of the data is very similar to the example I gave you guys, but this is more complicated. This is a complete income statement data you will have to do the data analytics. So you can see that for the sales, you start with sales. The sales variable you will be available, and then after sales, you have cost goods sold, you have a gross profit, and you have different R&D expense, staff expense, pension expense, rental expense. So you have all the variables available for you to do the calculation. And then you have operating income from depreciations, and you get and you have depreciation, and you have an interest. So this is very similar to the example I gave you, but this is a complete example. That one I gave to you, it's just example for illustration, just to guys get the idea. This is what you see from the real firm. This is real firm data for the income statement. So you can see that they have a non-operating income, and you have the special item, pre-tax income statement, you have tax, and you have income from extraordinary item, blah, 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 and you have everything, and you have earnings per share, and you have other information. You have the statement acquisition. You have, so there's many information here, many information here. So the idea here is how can you consolidate all the numbers together and tell investors this is the company that we want to invest. And you can tell investors, managers, oh, you can tell managers, oh, hey, the company is not doing well. There's some like a liquidity issue here. So basically, idea here is you analyze all the variables to provide insightful comments, recommendation for investors. Also provide insightful comments for managers to manage the firm, manage the cash flow, manage the liquidity. So this is the income statement. The folder is on the file is on the file. So Sharon can upload the file in case students want to take a look. So so basically the big picture here is this is a very complicated information. You start from sales, and then you have the expense, you have earnings, you have other earnings, and you have You have all other information, acquisition, merger acquisition stuff. So these are the a lot of information you need to reconcile. You need to consolidate in order to help investors. I want to make the case a little bit more complicated here. Let's look at the balance sheet. The balance sheet is also complicated here. So you can see that we start from the current assets. We have a cash, we have a short investment, we have a receivables. So you have a non-current assets. So you can look at this, how many variables we have from the balance sheet. We have about 124 variables available from the balance sheet. And how many we have from the income statement? We have about 120 variables from income statement. How about cash flow statement? How many variables we have from cash flow statements? About 35 cash flow statement. So idea here is if you adding all these variables together, we have around like 250 variables available from the financial data. So the idea here is I'm not counting stock returns, right? This is just fundamental data. We have a stock returns. We have a liquidity. We have a trading volume. I'm not counting those, right? I'm not counting those. So what I'm saying is just from the balance sheet, income statement, the cash flow, we have a 250 variables for you to analyze. So if you are professional, if let's say one investor asks some of you, let's say Chao Chu, investor come to you say, hey Chao Chu, there's a huge information here, 250 variables. Can you tell me what I can learn from the 250 variables for the firm? So Chao Chu, that's what you need to do. You need to know how to analyze these variables and generate some useful recommendation for investors, right? And also you should analyze these 250 variables and provide good comments for managers. And that's what we learn. That's what we learn from this class. That's what I want to learn from this class. And how do we do so? How we can actually generate insights from these 250 variables? It's more than 250 variables because we have a stock returns, stuff, momentum, so it's more than. So how exactly we can do so? How exactly we can do so? Let me share my other screen. So there's a two approach. There's two approach to do so. One approach is you come up with a theory, and then use the theory to test whether the theory, the pattern generated by theory can help investors and managers. That's one approach. Another approach is using machine learning. The machine learning approach is a little bit more of like a high dimensional data process. So basically, you throw in all the 250 variables into the machine learning as an input, and then the machine just learn by itself, just keep training itself and tell you which one, what kind of pattern can help you generate future stock returns. So let me talk about the two approaches side by side so you can see what's the idea behind. So what's the example of theory-driven approach? So what I just talked to you guys now, that's a theory-driven approach. Does it make sense? Because I tell you the primary business, the income from primary business is more persistent than side business income. So we prefer firms income are most from the primary business, not side business. So that's a theory-driven approach because I have that in my mind. I have the theory in my mind. I think the primary business will persist more than the side business. So I prefer firms to have a higher proportional income from the primary business. So this is a theory-driven approach. And later on, the team 4 will present a paper, present the research. That's also theory-driven approach. So in this approach, what we have is you have some theory ahead of the game. You have some like a speculation. You have some hypothesis. You have some theory back up your prediction. So for here, the theory is I believe primary business income is more healthier than other business income. That's the theory. And I use that to test whether firms have more primary business income will do better than firm whose income are from side business. That's the theory-based approach. I use that to have the theory to test that theory is correct. That's one approach. So what's the second approach? The second approach is the machine learning approach. What I do is I put the 250 variables into the machine learning model. And the beauty of machine learning is it's like a human, they learn. So I take an example of we just had the national entrance exam finished, right? Past week, we have the exam finished. So think about it. If you take the national exam again, second time, would you learn something? Would you do better than the first time? Possibly. Okay, you guys disagree. Okay, let's say you do the national exam again in the third time, fourth time, 1,000 times. Would you think after you've done the exam for 1,000 times, would you think you will do better than the first time you take the exam? Would you believe so? Okay, you guys still disagree. Okay, and I don't know. I don't know if normally, okay, on average, the more you take the exam and you check the answer and you see something is wrong and you review and you come back and forth, normally the learning process will improve your performance on the national entrance exam. Normally. So the machine learning is the idea is the machine can do the same. Instead of human learning, machine can also take the exam and learn, take the exam and learn, take the exam and learn. So the good thing about the machine is machine can like do the high computational power, can calculate like thousands times, millions of times just in very quick time. So what you are trying to deliver here is machine can doing a repeating process, learning which variable is important, which pattern is important. After thousands of trying and learning, taking the exam, machine can figure out of 250 variables which is important, which variable set is important. That's the machine learning approach. So that's the two approaches you guys have available right now. One is you have a theory first and you test the theory. Another one is you tune the machine learning model and trying to do the dimension reduction, and machine can keep learning. Like I said, you can take the exam again and again. Machine can also take the exam again and again. Every time machine take the exam, machine can find out which part the machine did wrong, and machine can improve on themselves. So what's the pros and cons of the two approaches? The theory-based ones, the difficulty is you have to come up with a theory first, and you test it. Some theory is correct, some theory is not correct. So for example, I said the primary business income is better. It might be correct, it might not be correct. So you have to test it. That's the first approach. The machine learning approach, the downside of machine learning approach is it's very difficult to interpret. So for example, the machine pick up 5 variables are very important. Like the 5 variables together can explain the future stock returns. But it's very difficult to explain why the 5 variables actually can do the job. It's very difficult to explain the machine learning model at this stage. But what's the good thing? The good thing is the performance is pretty good. So the idea here is the machine learning approach can deliver a very powerful tool. They can tell you that which 5 variables together can explain the future stock returns. The machine learning model can do that in a very powerful way. But the problem is we don't know why behind. We don't know why behind. We don't know what's the theory behind. What's the theory behind that? And that's the trade-off between the two approach. So one is theory-driven, another is machine learning-driven. So for this class, most of the time we focus on a theory-driven approach. To use that to help you, you have a theory first, and then use the theory to test whether the theory can help investors and managers. Most of the time we have a theory-based approach to analyze the income statement, balance sheet, all the bank data. For this class, we have a theory-driven approach. However, I want you guys to understand the machine learning approach too. We have 1 or 2 sessions on the machine learning approach, so you guys can understand how exactly you use the machine to train the model and to help investors to make decisions. So that's for this class. Let me just repeat one more time. Most of the time we will do the theory-driven one. to get insight from data. But we will have 1 or 2 sessions on the machine learning part, and you guys learn like how to use machine learning to do the job. At the same time, you guys be aware of the limitation. Interpretation of the machine learning model is very difficult. So basically, you can predict the return in a very consistent way. You just don't know, sometimes don't know what's the theory behind. Okay, that's for the two approaches. So let's look at the income statement. Okay, let's look at income. Let's focus on a theory-driven approach now. Let's look at the income statement. So like I said, I want to focus on the primary business income, operating income. The non-operating income is like other income, side business income. So for every income, you can look at whether how much is from the primary business, how much is from side business. Okay, this is a very simple regression. It's a very simple regression. I want you guys to be aware. This is our project 1. Okay, our project 1, the Excel project is due next week. So check out, talk to Sharon about this project. I want you guys to do well. So this is about the first project. So what does this mean? So this is X. The X here is the earnings per share. The price here is the stock price of the company. So this is the regression. This is the regression we have. So on X, X is the earnings per share. The Y is the stock price. You see a slope. The slope is the relation between the stock price and earnings. So basically, idea here is once you have more earnings, you should have more stock price, higher stock price. So the beta here should be positive, right? Beta here should be positive, some number, positive number. If it's negative, that doesn't make any sense, right? The negative, that means what? That means the more earnings the company is making, there will be lower stock price. That doesn't make any sense. It cannot be zero. If it's zero, then the company will not make any profit. That means zero means no matter how much money you make, the price will be zero, right? So the beta here must be some positive number here. Does it make sense? Does it make sense? Okay. Okay. The idea here is which company has higher beta, which company has lower beta? That's the question I'm trying to ask in here. Which company has higher beta? Which company has lower beta? So in other words, let's say if Apple have $1 earnings, and let's say the stock price is $10, that beta is 10, right? Beta is 10. Let's say Microsoft $1 earnings, the price is 20, that beta is 20. So why some company $1 earnings leads to $10 stock price increase, but when sometimes $1 earnings leads to $20 stock price increase? So why the beta sometimes is higher for some firm, sometimes is lower for some firm? This is we want to get the intuition out. We want to get intuition out. So good. Excellent. I saw some answers. Excellent. Very good. So let's say how do you get the price determined? So this is the typical cash flow model, discounted cash flow model. You guys must learn. Most of you guys are junior and sophomore. So what's the idea here is you discount each period's cash flow in the present. So you discount the cash flow here to time 0, discount the cash flow at the period 2 to time 0. So you discount all the cash flow in the future into the present, and the present value of all the cash flow, that's the stock price in a fundamental way. So the idea here is how exactly can calculate the future cash flow. So the idea here is if you have more future cash flow, do you have a higher price or lower price? Of course, higher price. Okay. If you have a lower cash flow in the future, do you have a higher price or lower price? Of course, lower price. So I think this is common sense, right? This is common sense because you are discounting the future cash flow into the present. So you have more cash flow in the future, you have a higher price now. If you have a lower cash flow in the future, you have a lower stock price now. So this is the very simple discounted cash flow model to determine the stock price. So going back to the question I asked earlier. So what I want you guys to do is you guys to decompose the earnings here, into different components. You decompose the earnings into the earnings from primary business, and earnings from the side business, and from earnings from like nothing, not related business. So what does that mean? So let's say Apple made $10 earnings. You will see that out of the $10, how much is from the Apple's primary business? How much is from the Apple's side business, like investment in stocks? How much earnings is actually doesn't matter earnings. It's like a window dressing earnings. So one thing I want you guys to be aware of this income statement analytics is you want to know the composition of the earnings. Do not just focus on the $10. I want you guys to focus on out of the $10, how much is from the primary business, how much is from the side business, how much is window dressing earnings. So what the idea here I want to tell you guys is, let's say if the most of the earnings are from the primary business, would you expect a higher beta or lower beta? If most of earnings are from the primary business, would you expect a higher beta or lower beta? Higher beta, right? Again, in other words, if the earnings are, most of earnings are from so do you guys know Apple couple of years ago, Apple has so much cash on hand. You guys are so into Apple, so you guys pre-purchase Apple. Apple has a lot of cash on hand. So Apple actually made a lot of money from stock investment a couple of years ago because they have cash. So let's say all earnings for Apple is from the Apple's investment, stock investment. Would that have a higher beta or lower beta? We will say have a lower beta, right? Because it's not Apple's primary business. We don't want that. So the impact on the price is low. Impact on price is low. So the idea here is, instead of just looking at the $10 of Apple earnings, you want to look at the decomposition of the Apple earnings. How much is from the primary? How much is from the side business? So this is the idea I want you guys to have. And so going back here, if this company, the primary business, the beta will be higher, right? If the company is if the earnings is from the side business, the beta will be lower. If it's just window dressing business, then the earnings should have no impact on stock price. So in other words, if most of your earnings are from the primary business, then on average the beta will be higher. So does that make sense? Does it make sense? Okay. And then let's look at just one example here. That's one example here. So that we have a firm A and firm B, or firm A and firm B. Both are making $10. So when you look at the example here, you can see that the primary business is 60%. Here, the primary business is only 50%. And the side business is 30%. The side business is 20%. So the both company A and B, they're making same money, $10 earnings per share. But company A, the out of $10, more is from the primary business, versus company B, only 50% is from primary business. And the company A, in that case, which one you prefer? Even the A and B making the same earnings per share, but A has more primary business component, B has less primary business component. Which one would you prefer? We will choose A, right? We will choose A. Because this is more healthier. This is more healthier. So what the project, what you guys do is, you want to make sure the company A has more impact on stock price compared to the company B. So so basically the project one is you will understand the relation between the stock price and earnings, and you will see that one company has more primary business income, the beta is higher. When company has less primary business income, the beta will be lower. So you want to invest in healthier firm, not the company A, not company B. So yeah, the message here is even though both company make $10, you have to look at the decomposition of the firm's earnings. You want to look at where is the $10 coming from. This is the about the this is about the income statement analytics, income statement analytics. So the following, what I want to do is I want to explain. I want to explain how do we calculate stock returns. So for example, earlier I was saying that there's a two tests, two based approach. One is theory based approach, another one is machine learning based approach. So for theory based approach, once you have the theory, you want to test it, right? So for example, here I say the primary business, one firm has more primary business income, the firm makes more money. That's the theory. You have to test it. You have to make sure this is correct. So the following slides we'll go over how exactly we test it. How should we test it? So so let's look at the how about let's have a break first. Let's have a break. You guys can get some water and stuff. Let's have a break and come back to test to explain the testing and